Hello and welcome to the CNBC-TV18's Mumbai studio. I'm Sonal Bhutra and with me is Pavitra Parekh. You're watching MF Corner. Well, Bandhan AMC just launched an NFO called Bandhan Multi-Asset Allocation Fund. The scheme opened on 10 Jan and will close on 24 June. This is an open-ended scheme investing in equity and equity-related instruments, debt and money market securities, and gold and silver-related instruments as well. So this is a category which has been picking up. Multi-asset has an exposure to the entire asset class. So it'll be interesting to see how Bandhan is positioning themselves here and what kind of contribution do different asset classes have here.
Oh, absolutely. I'm excited to hear what our guest has to say. Let me welcome on the show now Vishal Kapoor, Chief Executive Officer at Bandhan AMC. Mr. Kapoor, thanks a lot for joining us and being on the show today. I'm going to come to the NFO in just a bit, but to begin, do you just want to explain to our viewers what exactly asset allocation is and why is it so important to look at asset allocation no matter who the investor is?
So thanks for having me firstly. Asset allocation, I think, can be best described by the age-old saying, which is don't put all your eggs in one basket. Now, while we've seen Indian equities really do very, very well over the last several years now, I think it's important to understand that different assets do go through different cycles. And historically, no one asset really keeps outperforming all the time. So there will be ups and downs. And therefore, the benefit of diversification that an asset allocation linked thinking can bring is something that investors should keep front and center in their investment strategy. So asset allocation is really to diversify your risk to make sure that you do have some amount of exposure to different assets, recognizing fundamentally that different assets will do differently at points in time.
Okay, yes, we take that point, and we should not be very emotional about one asset class, right? So has to have exposure to different ones. That is about asset allocation. But now suppose someone is looking at a mutual fund or investing in any asset class. How important do you think is the past performance of any asset class while working on asset allocation?
So, and that's a very important point that you raised, that, when we look at common investor behavior, we see that often we look at the recent performance of any, whether it's an asset class or a fund or a scheme or a stock even, and then decide based on that. And that can lead to a bit of a behavioral sort of trap because, if the asset class that you're buying into is something that has recently done well, it's not necessary it will continue to do well. And often a flip happens and some other asset class does well. And that sort of behavior, which is, which has recency bias built into it, leads often to suboptimal returns. Because, as an example, you're choosing a product based on previous performance and it doesn't do very well. So next year, again, you flip your portfolio again. And there's just too much of churn and activity in the portfolio. In our studies and several studies across the world, you find that when you have a well-allocated product or portfolio, scientifically built, it can actually outperform just by actually doing very little, which is to stay invested at different points in time and systematically just rebalance it, which is take back a bit of your profit, invest into the asset class that is not doing too well at that point. And that actually leads to far better risk-adjusted returns. So actually an asset allocated portfolio across most long-term cycles should give you far better returns when adjusted for risk. And that's the true beauty of long-term investing.
Oh, absolutely. And, this is something that can really benefit anybody, a lot of new investors as well, who perhaps, have only seen the market go one way and have not started doing this yet. But at a time when we are talking about maybe more moderate returns for the Indian market, it's even better to look at this. But Mr. Kapoor, take us through your idea of launching the multi-asset fund and why now? Do you think right now is a specifically good time to be looking at this kind of allocation?
So to be honest, asset allocation is always a good idea. And why now? Possibly also because when you look at recent flows into our industry and flows into, generally the environment, we do see that a lot of the higher or the more riskier buckets of our industry, for example, thematic funds, the small caps, mid caps, etc., have been attracting a lot of flows. Also because they've done so well. They've provided very, very attractive returns. And, as the saying goes, risk is what you can't see coming. So while everything is good, it may be a good way for us to actually take a step back and reassess whether the risk that we have on a portfolio is actually what we want, or are we getting overextended. Now, this is a very personal choice, but the point is that when going is good, this is the time to actually diversify so that you're not hit if a turn or a fumble were to happen at some point in time in the future. So while asset allocation is always a good idea, it's a good time for us to reassess, refocus on what our goal was, and consider the fact that return adjusted for risk is what we really want, not just chase recent return and then be disappointed because either our expectation was too high or the risk we took ended up being suboptimal or basically lopsided.
So it helps investors manage emotions, as you've said. But give us a sense of this particular NFO. What will the split be between different asset classes in your own fund?
So in our fund, we are taking an approach of what I would call combining the science and the art. And the science of the fund is how we have built the core strategic allocation. And the core strategic allocation comes as a result of a lot of backtesting, a lot of modeling of data over long periods of time. And our conclusion of that study is that we think that for a growth-oriented long-term Indian investor, a 50% allocation to Indian equities, that to split across large cap, mid cap, small cap, is a good way to start. A 15% allocation to international equities, again split across the US, other developed markets as well as emerging markets, is a good way to achieve diversification and the opportunity in international equities. So 65% equity weightage. The remaining 35%, in our view, 15% between arbitrage and 10% in fixed income gives the portfolio a reasonable amount of stability, and a 10% exposure to commodities through precious metals, in our case, gold and silver, is a good way to actually benefit from the commodity cycle at different points in time. So the fund actually offers in one very effective, very scientific package, a very good exposure to 5 different asset classes. So one fund, 5 different asset classes, and actually 13 sub-asset classes underneath. So very effective way, very efficient way, also very tax efficient, because currently this would be qualifying under equity taxation for investors to gain exposure. Now, the art of the fund is in the way we manage each of these asset classes, and that will be actively managed. So, for example, in Indian equities, we will take a multi-cap approach. Dylan is the fund manager looking at that fund, which he also manages the multi-cap fund for us. So investors can therefore hopefully benefit from both the science and art of fund management in this fund.
Okay, so you were mentioning that the 50% which is for equities will be sort of managed like a multi-cap fund. So we should see pretty similar kind of allocations to all of the market caps?
Largely, yes. So we've defined ranges of large cap, mid cap, and small cap in that order. So there is some flexibility available to the fund manager to take exposures into each of these asset classes. But the idea is that at all points in time, you will have a minimum allocation across each of these asset classes, like the multi-asset category forces us to do. So the minimum allocation will be 25% in mid and small caps respectively, and the large cap will have a minimum allocation of 30% of the equity portion. And that leaves some amount of room for shifting between these asset classes for the fund manager to try and generate alpha over a longer period of time.
Okay, we take that point, and later on, if time permits, we would like your take on some of these other segments as well, the mid caps and small caps. But now we'll focus on the NFO. But before we do that, Mr. Kapoor, we'll have to slip into a quick break. On the other side, we'll continue our discussion with you on asset allocation for funds, for investing, and your NFO when it comes to Bandhan Mutual Funds. Stay tuned for that.
Hey guys, welcome back. You're still tuned into MF Corner here on CNBC-TV18 and we still have Vishal Kapoor with us. We're talking all about multi-asset allocation funds as well as their new fund offer in this space. Mr. Kapoor, we've spoken a lot about the equity side, but take us through the debt part as well. How will this be invested and, what duration are you looking at for just the debt portion?
So again, in debt, we are looking for high quality exposures, and within high quality, we will look at government bonds, the top end corporate bonds, as well as money market instruments. Within the space, we will want to keep duration dynamic and therefore active. So the idea is debt does provide the level of stability and shock absorption to the portfolio. But within that, if the fund managers can find some room to create alpha, then we'll try and do that. So that's the idea on debt. Keep in mind the combination is what we actually focus on between equity and debt. And since there is little correlation, that's the benefit of bringing the equity and debt class together in this fund. Like in our active duration funds right now, we do think that taking on some amount of higher duration at somewhat close to the peak of the cycle may be beneficial in the current environment.
Okay, so debt funds stabilizes your asset allocation and gives you some support when it comes to the other volatile classes as well. But how are you looking at international markets currently, Mr. Kapoor? You're investing in overseas ETFs. Which markets will this cover?
So again, the idea will be to cover all three subclasses, if I can call the US as one large subclass, which largely accounts for almost 60% of global allocations. Developed markets, non-US, as the second asset class on the global basis, that's almost 20%. And then emerging markets as the third asset class, which is again, under 20%. So if that's the overall, market, the global market, the idea will be that the fund managers will be broadly in line, but can take a bit of an overweight, underweight view to these, the 60-20-20 allocations based on their view at any given point in time. We are choosing to do it through ETFs. So as you can see in this fund, we've tried to combine a lot of very interesting ideas. A large part of the portfolio will be actively managed, but there are some portions like international investing where we think a passive management approach may be far more efficient because it's 15% and a 60-20-20 with some amount of tactical plays between these three asset classes, we think should be able to provide investors with very attractive, again, rebalancing to their other exposures in the fund.
All right, really combining the best of all worlds here, not only in terms of assets, but also in terms of the investment approach, right? Active and also bringing in some passive. But do you also want to take us through what the taxation of this fund will look like just for the benefit of viewers so they know what to expect?
So as we currently understand, taxation, this should qualify for equity taxation because gross equity exposure, as you saw, is above 65%. But I would want our viewers to focus more on not just the return in this fund, but really the behavioral aspects of this fund. Again, coming back to to what we started with, at times what can happen is that recency bias leads to a lot of performance chasing, where we get very excited about recent performance, and that seems to be happening in at least certain pockets of the market today. A fund like this, what it does is that it tries to stabilize and use the benefit of asset class movement over long periods of time to reduce your volatility significantly. And reduction of volatility is important because a lot of Indian market investor data also seems to suggest that while the fund may deliver a reasonable return over a long period of time, the investor often actually does not get that return. And that's because we move in and out, possibly at the wrong time. So sometimes, to encourage investors to just stay put over the long period of time, a fund like this can really help because whichever part of the market is doing well, you're likely to have a reasonable exposure to that part of the market through this fund. So hopefully, this is a fund where you can have a sizable allocation and hold on for a long period of time because you have the comfort that any part of the market that is likely to do well over different cycles for a long period, this fund will give you a reasonable exposure through that. And while doing that, because it's a strategic asset allocation, it will manage towards a much lower volatility than the underlying asset classes.
Okay. All right. So you did indicate that one should look at it as a long-term portfolio in their asset allocation, and generally the returns have been equal to what the Nifty returns that we have seen. But of course, there's volatility cushion that different asset classes provide here as well. You know, I wanted your sense generally on the markets because we did get the monthly data mutual fund flows this time around, record high SIPs yet again. So the mutual fund cult continues when it comes to investing. And in that, hybrid funds, they have made a big comeback. What do you make of that? It's slightly similar to multi-asset. Do you think these segments will continue to do well in 2024?
I think that trend has been, getting stronger. And within hybrid funds, clearly multi-asset funds or asset allocation strategies, including the dynamic or the balance advantage funds, have been doing quite well. There is also the arbitrage category, which is done well, primarily for 2-3 reasons, at least in our view. One is that arb yields have been quite high, given the strength in the equity market as well as the amount of momentum that we've seen. Underlying yields also have been attractive. It's also very tax efficient. So for a lot of HNI customers or people in the high tax bracket, it's a very effective way to have a reasonable, stable, yield through a product which is actually quite efficient. But otherwise, I think it's good to see that a lot of investors recognize that hybrid strategies which can combine equity as well as debt do end up giving you similar returns to the underlying or to the best performing asset, but actually at a significantly lower volatility. And that value seems to be gaining ground now.
Oh, absolutely. It was quite a fascinating number to see. Even the arbitrage was over 10,000 crores. So definitely looking good there. One final question. How are you looking at this entire mid and small cap kind of frenzy that we saw over last year? You know, even in December, I think small caps came in at a very, very strong number. Mid caps have pulled back a bit. But, people seem to continue to be interested in the broader markets and not so much in the large caps. So how would you look at that?
So we look at it largely from an investment standpoint. Of course, like I mentioned earlier, for the investors to come into small cap in the sort of, aggressive manner that they have, one will need to look at your individual risk appetite and what's your expectation. Now, certainly, if you've looked at last 1 year return and small caps have been, 50, 60, 70% returns, depending on when you came in, that may be very difficult to sustain going forward. So clearly, be very, very mindful of what your expectations should be from equity assets. But having said that, in the investing world, we still think that our fund managers are looking at or are seeing enough opportunities, even now, in good quality small and mid cap companies. Often it is said that, where is the opportunity? Do we really have too much choice? One way to look at it is that, in our view at least, a lot of the growth going forward may be based on domestic factors rather than growth from export-oriented, segments or the larger cap structural stories in a sense. So if growth is going to come from more micro stories and some of the more domestic homegrown themes that are benefiting, for example, from the informal to formal sector, just as an example, there is at least a wider choice available in the small cap. So if you look at the investing universe available to fund managers in the small cap, it does seem much wider than what is available in the large caps, because you're then looking to choose about 1 in 5, 100 out of 500 companies that seem good by and large to make up a portfolio. The underlying expectation of earnings growth in these companies does look reasonable, and for the earnings growth that they are that we are expecting, the pricing looks again reasonable. One can't say they are cheap, but they may not be outlandish either.
Right.
So a balance of factors would make us feel that it is still not a bad place for an investor long term to look at. I would be cautious about what the mutual fund investor is expecting out of the small cap, and certainly one should not expect the very, very strong year-over-year growth that you've got. But otherwise, no reason to believe that from an investing standpoint, we don't have enough growth opportunities in small and mid cap.
Okay, all right. We take that point. Mr. Kapoor, thank you so much for joining us today, taking our time and taking us through your new NFO details and more on the markets as well. With that, we'll do one thing. We'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.